This is an example problem about accounting for debt and equity securities. The problem states, during 2011, Crab Company purchased 5,000 shares of Snail Company common stock for $18 per share and 3,200 shares of Lobster Company common stock for $21 per share. These investments are intended to be held as ready sources of cash and are classified as trading securities. Also in 2011, Crab purchased 6,400 shares of Shark Company common stock for $27 per share and $80,000 of Treasury notes at 103. These securities are classified as available for sale. During 2011, Crab received the following interest and dividend payments on its investments, and we'll come back to these in a second. The fair values of the securities at December 31st, 2011 were as follows, and we'll come back to these in a second. And these are some other transactions that happened. On March 23rd, 2012, 3,200 shares of Lobster Company were sold for $16 per share. On June 30th, 2012, the Treasury notes were sold at 102 plus accrued interest. And then these are the fair values of the remaining securities at December 31st, 2012. So what we're going to do is prepare all the journal entries for 2011 and 2012. So the first thing that happened is these purchases right here. So that's the first thing we're going to go to. In 2011, for trading securities, we have this entry right here. Investment in trading securities of 157,200. This is to record the purchase of Snail Company stock of 90,000 and Lobster Company stock of 67,200. And that's just the share price multiplied by the number of shares that we purchased. For AFS, or available for sale securities, we have this entry. The investment in available for sale securities is the same thing. We record the purchase of the Crab stock at 172,800 and the Treasury notes of 82,400. The Treasury note was 80,000 purchased at 103. That just means 80,000 times 1.03. That's 82,400. Now this is reflecting our dividend and interest payments, that are right here. These interest and dividend payments we received in 2011, and that's what this entry is explaining right here. So first we have cash for 26,100. We have dividend revenue for 22,900 and interest revenue for 3,200. The dividend revenue breakdown looks like this. So Snail Company, you have 5,000 shares times $2.50 per share. Lobster Company's 3,200 shares times $1.25 per share. Shark Company's 6,400 shares times $1 per share. Gives you a total of 22,900. That's this entry right here. Interest revenue. The interest revenue from the Treasury notes for 6 months is 3,200. It's just 80,000 times 0.044%. That equals 3,200. Now at the end of 2011, we need to make these entries for the fair values of these securities. And that's what these are right here. These four are these two entries. Now first, for trading securities, we have an unrealized loss of 1,000. The way that looks is this. This is to account for the decline in the carrying value of the trading securities. Snail and Lobster's combined carrying value was $157,200. But at the end of 2011, the value of Snail's stock had gone up, but Lobster's had declined. So this lowered. If you multiply these out, the total value has gone down by 1,000, and so that's how you get this entry right here. And then for the available for sale accounts, you have an unrealized decrease in value. This entry reflects the overall decline in value of the available for sale securities account. The Treasury notes increased in value, but the Shark stock declined enough in value that it lowered the overall AFS account by 18,400. So as you can see, if you add the costs together, they were at 255,200. At the end of the year, you had a total AFS value of 236,800. That's a difference of 18,400, and that's how you get this value right here. Now in 2002, we had these transactions happen. We sold all of our shares of Lobster Company for $16 a share, and we sold the treasury notes at 102 plus the accrued interest. And so that's what this entry is right here. This is for selling the Lobster shares. So you have 3,200 shares of Lobster Company at $16 a share. That's that cash amount of $51,200. But the cost of the shares were $67,200. That's a loss of $16,000. So you put the realized loss right here. It's a debit cash for the amount that you actually received, and the total investment in trading securities was lowered by $67,200. Now to account for selling those treasury notes, right here you've got cash. That's how much you received. The realized loss is $800 because the cost of the notes were $82,400, but they were sold at 102 of $80,000, which is $81,600. So that's a difference of $800. The investment in AFS securities goes down by the cost of the notes because they were sold at 103 of $80,000, and the interest revenue that had accumulated was $80,000 times the 4% again, so that's $3,200. Now on December 31st, 2012, we have these adjusting entries again, and these were the values. Snail Company $20 a share, Shark Company $30 a share. So for this one, okay, I moved that down so you can see this. The market adjustment trading securities, the realized loss on trading securities of $16,000 lowered the value of the trading securities account from $105,000 to $89,000. And then when the value of the Snail stock is at $20 per share at the end of 2012, that raises the trading securities account value to $100,000. That gives you an unrealized gain of $11,000. That's these entries right here. For the market adjustment to the available for sale securities, this is a market adjustment that accounts for the $19,200 change in the value of the AFS securities account. And you add that to the AFS adjustment from $18,400 that happened in 2011, and that gives